Hey everyone, welcome to the Henry Show. Today I'm going to talk to you about how I manage my nearly $500,000 portfolio. So I went into some detail looking at Portfolio Visualizer in the last video, and I showed that pie chart of a portfolio that looks roughly like the one I have, but today I'm going to go into detail about exactly what I have. And you can see that many of the same things are here, the same themes I've talked about. Again, these are the buckets, so there are some individual stocks and ETFs within these. But I have the NASDAQ. I love the NASDAQ. This is something I'm targeting 55% of my portfolio for. I think that big tech and disruptive innovation in this space is essentially software is going to eat the world. And so whether the economy is growing rapidly or whether the economy is stagnant, these guys are going to win a zero-sum game. They're also going to win a growth game. If the whole world is doing well, they're going to do well. If the whole world is doing poorly, they're going to eat your lunch. So I have a strong belief in the NASDAQ big tech companies outperforming. And that's why I expect to return at roughly 12% compound annual growth rate over the long term. In the last 10 years, we saw in Portfolio Visualizer, this is actually closer to 17%. So I've gotten fairly conservative in my expected returns. These are made up numbers that I just estimate over the long term I expect these asset classes to perform as. Then we talked about Brookfield. Brookfield has also demonstrated significant performance in an over 20-year history of 15% compound annual growth rate. In their investor material, they also talk about this being their internal rate of return target for their internal investments that the company makes. So they're trying to hit this number, and they're also trying to make the stock grow at this number. So that's what I put for essentially real assets is Brookfield Asset Management for the most part. Lastly is Bitcoin. I'm definitely going to do a video going into the details of my Bitcoin thesis and why I think it's a worthwhile investment to consider. I'm putting a 25% expected return. Frankly, I think it's going to do much, much better than that, and historically has done much better than that. But at the same time, if I put this to 100%, it would just make all the numbers look really, really weird and crazy. So I put this at a more conservative 25%. US long-term treasuries, this is something I'm targeting. Right now I have 17% of my portfolio there. This is actually a very tactical medium-term trade for me. I'm looking to hold these over the next 3 years, and that's because I made a speculative trade based on a theory about interest rates declining, which will lead to a spike in the price of TLT. So yeah, I'm only getting 4.5% interest, and then I'm paying 50% taxes on it, but I do expect to get a 20, 30 plus percent pop over the next 2-3 years when we see interest rates decline. I think it's going to happen if we have a recession. I think it's going to happen if we don't have a recession. So that's why I put that at 9%. And I actually have a much more detailed calculation and math and research on why I think this is the number. I didn't make it up out of my ass, but that's for a later video. Mad money. So individual stock picks. I call this mad money because it is mad. It's a bad idea to pick individual stocks, but it's sure a lot of fun. So I'm definitely going to make some individual stocks picks on this channel, but I'm limiting it to 5% of my portfolio. And right now I am only actually invested in 3% of my portfolio, less than 3% of my portfolio into the mad money. And I need to beat the index to even consider this, right? A lot of people just say, oh, I'm going to diversify. And essentially they recreate an index. And there's no way they can track 20, 30, 40 stocks. I'm trying to do 2, 3, 4, or 5 stocks at the maximum. And I'm trying to make sure that they're really, really good opportunities. And I'm going to bet on those. And I'm going to watch them carefully. And I'm going to manage the sizes of those positions so that if it does blow up by 50%, I'm still going to be able to sleep at night. I'm still going to be able to reach my financial goals. Lastly is cash and options. I consider these something that work together for me. So I use options to actually get in and out of positions that I want to be in. So for example, why did I allow the NASDAQ to drift so far below its target? It's almost 4% off its target. That's according to the sheet. I have this pretty handy bit here to calculate how far I am from the target and also how many shares do I need to buy. I'm 35 shares short on the NASDAQ, but I'm going to sell puts and say, give me 100 shares and I'm going to get some money for that. And I'm also going to be able to put that cash aside that I would buy it with and get 5% interest in T-bills. So I'm making about 12% between the options premium annualized and the cash interest rate, which is great. Now I'm paying heavy taxes on that, but options are something that I'm actually trying to buy an education in now. I think options are an incredible tool for you to generate income in retirement, but I don't want to wait to retirement to make my mistakes. So it's not an optimal strategy to sell options for a Henry because it is so tax heavy with all the short-term gains that you create, but it is something that over the long term I do expect to benefit me. So people talk about the safe withdrawal rate being 4%. I think if you're master option selling, that number could be 5 or 6% or even higher quite easily. So yes, so cash and options are the last part of my strategy. And you add these all together against a $478,000 portfolio, and I expect to make about $70,000 a year on average over the long term, which gives me about a 14% return. Now, guys, we got to talk about this percent. What should something reasonable be? I see a lot of people reaching for 20, 30, 40% returns, and the truth is there's no free lunch in this game. If you are doing something that you expect to achieve that return, you're probably taking on either very concentrated risk or too much leverage. And both of those things create opportunities for you to blow up your whole account. And that's something we absolutely need to avoid, especially when we have a large account that is going to take many years to build back up. You just can't take that risk. And I think somewhere between the 10 to 15% range is really what you should be targeting if you want to bump up that return a little bit, but not to an insane amount. I think anyone getting 15% consistently year over year over year and making a high income in the $200,000, $300,000 plus range is going to meet all their financial goals. It's no worries. So don't bite off more than you can chew. Take it slow. I mean, even 8% just put in the S&P 500 is definitely going to be better than nothing, and frankly a very reasonable start. But if you want to take on more risk because you are a high earner and you can afford to take that risk, then keep it 15% or below, please. If you're seeing numbers higher than that, you're probably doing something that's going to lead to you blowing up your account. So just be careful. And if you're going to invest in assets like Bitcoin that you're looking for higher than that, it's probably, Bitcoin can also go down over 50%, right? So it's very volatile. It introduces more risk. You can't put 100% of your portfolio there. You have to be measured. So, yep, that's my investing allocation spreadsheet, and this helps me figure out what I need to buy, what I need to sell. And this here shows I actually below in the spreadsheet, I actually capture how many shares I have of each asset, and I sum them up into these buckets. And then I compare that to the target value, based on these target allocations, and it tells me how many dollars and how many shares I should buy. So for QQQ, right, I'm short 16,000. I really should buy $16,000 more. That's about 35 shares of QQQ. For Brookfield Asset Management, I'm about $7,000 short of target. That's about 156 shares. And it looks like I have a budget of $10,000 to make some fun individual stock picks. So that's definitely something I'm going to focus on releasing a couple of videos here, as I have a bunch of ideas for individual stock picks that I'm going to share with you. But something else I want to talk about is the options trading and how do I go about that? So Brookfield right now is a timely example because I'm short 156 shares, and 100 is the magic number because when you sell one put contract or one call contract in an option of options, it means you're obligated to sell or to buy 100 shares of that asset. So if I want to buy 100 shares or more of Brookfield, that means I can sell a put against it. So I have a tool here which I've built, which is a spreadsheet that allows me to figure out what is the annualized return that I expect. So let's take, this is my paper trade section, and then up here I actually capture and document the trades that I have actually executed. So here in Brookfield, I looked at both, I'm looking to sell puts. I looked at this 2 days ago. I set an October 18th expiry, so I took a fairly long option there, and I looked at both the $45 strikes and the $40 strikes. Brookfield is trading around 44 and change right now, 44.70 or so. So this is a little bit in the money, and this is very far, quite out of the money. I'm getting significantly more premium for the higher one, but I'm also getting some reasonable premium here at the $40 and much, much less chance of assignment. So I'm trying to decide, do I just want to go ahead and buy the shares and get $2.30 premium, almost guarantee I buy the shares? that's an annualized return. As I can see, if I move the spreadsheet over here, I can see I can make an annualized return of 12% plus 5% on the cash for as long as I hold it in reserve for this. So that's a very decent 17% return. Again, I'm paying 50% taxes on it, but still very solid. Or I could sell the more out of the money puts for around 7% and then also get that 5% interest in my cash reserves. So that'd be about 12% annualized return when you combine the cash and the options. The interesting thing is I can take a bit of extra risk and extra leverage by selling more contracts at the 40. Right now, it's almost certainly that I'm going to be assigned on the 45 unless there's some massive price growth in Brookfield over the next few months. But it seems pretty unlikely to me, and this is where you have to get into the technical analysis and know your stocks and know where their trading ranges are. But I don't think 40 is all that likely. It's possible, but it's not very likely in my mind. So you're basically collecting this as free money. So I could sell 3 contracts. And the question I have in my mind when you think about options is, would I rather? You have to think about both paths, right? So for selling the $40 puts, in the bad case, or the case where I get assigned, I'm now going to have to buy 300 shares. And I'm looking for, again, going back to it, 150. So I'm a little bit over, but not significantly. So what if I'm at 17%? I go from 13% to 17% here in my target versus actual allocations. It's not a big deal. I can afford to do that, and I have some cash set aside, so it's perfectly reasonable for me to sell these puts. But if I'm trying to get the shares acquired and I have a view that Brookfield is going to grow rapidly, I might just try and be more aggressive, take a shorter option date, and really try and get assigned and collect a few pennies along the way, which is more on this option. So I'm debating that right now, and this is definitely a sheet that I use frequently. And you can see here I document every trade that I have every year. So right now I am last year I was very conservative, took very small short trades, and I tried not to lose. I only lost once, and you can see I had a net of $1,600, which isn't a lot, but my goal was to be having a very high win rate with these options. That's still my goal this year. You can see I did lose one. It was actually my first covered call, and I end up, so those aren't as bad to be assigned because I just made less money than I would have, not lost money, but still because the stock I was holding went up, and I got assigned on the call side. But you win some, lose some. Right now I'm looking at, if all my options expire out of the money, I'll make about $8,600 this year, which is significantly more than I made last year. And that's a combination of, selling more options and selling longer dated options to get that extra premium. So yeah, that's my video. This is how I manage my $500,000 portfolio and how I strategize around it. Thanks for watching.